Neal, Brincefield, and we're going to be talking about the 15 rules talk that could occur in an open meeting or maybe at the beginning of a protection meeting. Okay. All right, Carly. So let's talk for just a minute about how we get organized. So it's one of the things that you mentioned as being of concern to you. You know, the way that most people get organized from a financial standpoint, and historically this is the tool that's been used, it's just a simple balance sheet. And basically what we're viewing in this kind of a model is assets and liabilities. We subtract one from the other and it gives us net worth. And that is an important measurement. Net worth does tell us, it gives us that snapshot in time. It allows us to keep score and say, where are you today? It gives us maybe some inkling of where you've been and where you might be headed, but really nothing beyond an inkling. While the goal of planning, and certainly our goal as well, is to increase assets, decrease liabilities over time so that we can increase net worth, we've got to go beyond that. Especially if we're going to really understand how healthy this world is, we need to understand the dynamic of this balance sheet. And the only way that we can truly understand that is to understand the fuel that feeds this financial engine. And that fuel is something called cash flow. When you and your husband earn $1, it goes somewhere. So the question is, let's understand the relationship between that cash flow and the assets that you're building and the liabilities that perhaps you're paying down over time. Or in some cases, vice versa. We don't really understand the dynamic. We don't see this as a living thing until we can truly understand how cash flow is associated with those other two domains. We're starting to get there. We're starting to really complete an overall financial picture and really understand where someone is from a financial health standpoint. But we don't do that fully until we can answer these questions about loss. In other words, where are we in terms of understanding these three rules of loss? And these three rules of loss that everyone needs to know is that loss can happen to anyone, it can happen any time, and when it does, it always goes somewhere on the balance sheet. So to give you an example, if you were to experience a house fire, and let's say that you weren't properly insured. That house burned down, you lost an asset of say $200,000. Immediately there's this impact on your balance sheet. It's always going to go somewhere. You can rebuild that house and put the asset back, but it's going to affect other areas on your balance sheet. You're either going to have to take out a new loan, which just increase your liabilities, or you're going to have to fund that new construction out of cash flow. Or perhaps just to service the debt on the new mortgage, you're going to have to impact your cash flow. So the loss always goes someplace on the balance sheet, and no one is immune from it. And for that reason, we really have to truly understand how well someone is protected against loss, to have a true sense of how well organized and how healthy and secure this financial world is. So that's what we really achieve when we look at protection. What is the relationship between these four parts? It's a critical thing to understand. And then moving beyond that for a minute, what are the ideals in each of these areas? So we understand that there's an interdependent nature of the four domains, but what are sort of the rules of the road for each of these four domains? Let's take a minute. I would love to walk you through sort of the ideal scenario that we're looking for in protection, assets, liabilities, and cash flow. And our goal for all of our clients is to move their world into as close an alignment with those 15 rules that we're about to go through as possible. In some cases it can be done overnight, and in some cases it can be done maybe over a period of years. It's something that we work towards. So let's have that discussion right now. First and foremost, when it comes to protection, we have three rules. And the first of these three rules really has everything to do with probability. So we really believe that protection is something that has to come immediately. Protection is something that has to come first because we don't know what might happen today. We don't know when someone's going to get sick. We don't know when someone is going to have a car accident. We don't know when those unknown events will occur. So we need to use probability as our guide. We need to protect immediately before we really do anything else. Secondly, if we're going to protect, we want to use full replacement. So if I have that homeowner's insurance policy on the $200,000 house, I want that to allow me to rebuild a $200,000 house if something were to happen to it, if there really was to be a house fire. So I want full replacement because, again, if I don't have that, then loss tells us that at some point that economic event is going to find its way onto the balance sheet. It's through and create a problem elsewhere. So I want to have full replacement whenever possible. And finally, I want to have permanent protection. There's never going to be a time when I feel comfortable peeling this layer of protection, this roof off the house here, and leaving the rest of my balance sheet exposed. There'll never be a time where I say, you know what, I don't need health insurance anymore, I don't want to have auto insurance, or I don't want to have homeowners insurance, or I don't need long-term care insurance. So I want to have protection wherever possible that will last as long as I do. Those are our protection rules, and as I mentioned, or as I alluded to, we really think of protection as sort of the roof on this financial house. It is the thing we need to build first before we put up the drywall and paint and get carpet and get furniture and that sort of thing. Let's get down into that area of the financial house here. So when it comes to assets, we have 4 rules. We want to achieve these 4 things always when it comes to your overall asset domain if possible. First, we want to have a reasonable rate of return. Because of something called inflation, we need to be able to realize the time value of money on the assets that you're building. We should be able to get a reasonable rate of return over time. But we don't want to have to take a ton of risk to do it, so we want to have minimal risk in your overall asset domain. Overall, that's always going to be one of our goals, and as I mentioned earlier, this is really critical for us. We're never going to ask you to take more risk than you're currently taking, and in fact, we may help you find a way to take less risk in your overall portfolio. We want to be able to achieve tax advantage over time in your asset domain so that we can sort of limit the effect or the burden that taxes can take on your assets over time. It sort of can feel like an anchor that you're pulling through life if you don't have a tax efficient strategy. And lastly, again, this has everything to do with efficiency. We need to have liquidity. So we need to be able to access our assets. We can't have them all, say, locked up in non-liquid vehicles because we don't know what's going to happen tomorrow. There are going to be sort of rainy day opportunities where we need to have access to our funds to be able to make an efficient decision. We need to be able to do that while still balancing these other 4 things. Okay. Liabilities. 3 rules. First of all, and most importantly, we want to eliminate short-term debt. Short-term debt would be things like credit cards, auto loans, student loans. They tend to have higher interest rates. They tend to have steep payback periods. They tend to not be tax deductible. We just don't see a place where maintaining balances like that over an extended period of time is a useful strategy. So we want to work to eliminate those as soon as we possibly can. We also want to reduce liabilities that we carry on our balance sheet. Specifically, rule number 9 is about reducing tax liabilities. This really ties back to the asset rules, but we don't want to carry deferred tax liabilities on your balance sheet beyond what is necessary. And if we can avoid it altogether, we really should, because what that does, in the instance of, say, like an IRA, a tax-deferred vehicle, if we're overweighted in that bucket, we're really leaving ourselves exposed to the danger of what's going to happen when taxes are maybe higher in the future, and we've got to pull all of our assets out at a much less favorable rate. So we want to reduce that over time. And lastly, we want to make the best possible mortgage choice. There are no cookie-cutter rules about mortgages. We know that. We know that a mortgage needs to fit in with everything else that's going on with your balance sheet, with your financial world. We need to think about cash flow constraints. We need to think about the timing, timeline-wise of the mortgage that you choose, with everything else that's going on in your life and your other goals. We need to think about the tax implications of the mortgage that you choose. So it's definitely something that we feel like a decision has to be made there on a case-by-case basis. And that is one type of debt that we feel like it's acceptable to manage over time, as opposed to just eliminate. Lastly, in this cash flow domain, we really have, the remaining rules are really all about prioritization. So our goal is to maximize the use of gross income over time. And make the best use of your gross income on the way up the mountain during accumulation. And then in retirement, we want to help you come up with a strategy to create the maximum gross income for yourself during those later years of your life. Next, in terms of what happens when we receive that dollar, every year when we earn that dollar, where do we put it? We feel like it needs to be spent in this order. As we already mentioned, it needs to go to protection first. Then we need to pay ourselves, we need to build assets. And we really feel like while a traditional rule of thumb might be to save 10% of your income, we know that in this day and age where people have less and less benefits provided, they maybe don't have a pension anymore, it's just an absolute requirement that people be able to save a minimum 15 to 20% of their gross income. Once we've saved, now we have the right and privilege to be able to manage our liabilities. And here's where we will not only pay our income taxes and other taxes, out of cash flow, we'll use dollars to eliminate short-term debt and make our mortgage payments. And then finally, we'll live a budgeted lifestyle with the net income that remains. This is a critical point. This is another area where maybe we're a little bit different than the rest of the industry. We're never going to ask you to change your lifestyle. We're never going to come back and say, you need to come up with $1,000 a month to make this savings plan work, or you need to come up with $500 a month for X, Y, and Z insurance. We're not going to ask you to do that. We're going to try to find the cash flow to pay for any recommendations we might make, and we're typically going to look to do that in these three middle areas. That's what we're going to look to make the best use of cash flow and redeploy dollars if necessary. It'll be up to you to decide if you ever want to take a hard look at that budget and see if we can make use of that net income more efficiently. If you do, if you would like to take a look at that, it's something that we have very useful tools and we have a lot of expertise in that area, and we can help you do it, but it really needs to be your idea. All right, any questions about the 15 rules?